So let's discuss how accredited investors value shares and how do they understand how much is the value of something, and then basically how much should they be paying for it. Let's dive in today's video. Hey and welcome to today's video. My name is Julian. On this channel, it's all about making you crypto fit. This means we discuss the beautiful world of decentralization, blockchain, cryptocurrencies, most of all Bitcoin. Every once in a while, we stray off from these topics and we discuss general investment thesis. And this is exactly what I want to discuss today. I actually want to go in and discuss how do accredited investors, how do sophisticated investors actually value shares. And we're going to look into discounted cash flow analysis, and I'm actually going to show you a tool that I kind of set up to do this automatically. So stay tuned, stay until the end because it's going to get really, really awesome. If you're on this channel for the very first time, do yourself a favor, click the subscribe button, click the little bell icon so you never miss any of those videos. Now, before we get started, let me show you a quick philosophy in how basically investment kind of works. Imagine it this way, and you have this little box here, and there's something inside, and there's probably a trillion boxes out there because there's something inside, right? There's a Bitcoin box where there's a Bitcoin inside, and then you have something called, an Apple box because there's Apple inside. And it doesn't really matter how many boxes or what kind of box you have. There's always this little monkey on top of it. Looks like a human, but it's like this crazy monkey. And this monkey is kind of shouting out prices, right? And this monkey is depressed. This monkey is euphoric. This monkey takes drugs. This monkey snorts cocaine. This monkey does any kind of thing that you can imagine. It's bipolar. It listens to the media. This monkey is crazy. But so now here's the key thing. Every once in a while, and this is actually a belief system, if you actually knew exactly how much this thing, whatever's in this box, is worth, every once in a while, and you need to take quite some time, this monkey actually shouts out the actual price of the value that's inside. Now, this is a philosophy that you need to have if you are a sophisticated or an accredited investor and you actually try to value certain things. So most people, they don't. Most people just try to look at whatever this monkey is shouting. So this is kind of the price, whatever this monkey is shouting, and people get all crazy about it. They're just as crazy as this monkey, right? But so every once in a while, people listen and pay attention. They're like, oh crap, this monkey just shouted the exact price of the value that I had calculated. Now, so obviously the question is, how do you actually calculate this value that's in there? And there's obviously, that's basically, that's what makes you millions at the end, because if you actually know at some point that you're very, very certain that this monkey kind of shouts out the actual price, and you can predict that with a very high degree of certainty, you're gonna win because you're gonna know if the price obviously is lower than whatever the monkey is gonna shout out with a very, very high probability over time, then you would be winning. And so one of those ways to calculate how much this monkey is basically shouting out is what's called a discounted cash flow analysis. Or DCF. And basically what you do here is the following. You calculate the cash that anything brings in over a certain period of time. For example, you can say most businesses, you would calculate this over 10 years. So what you would be doing is you're calculating that the monkey can shout out a price, let's say over around 10 years time, right? So you give yourself quite a long time because it's easier to calculate whatever the monkey shouts out over a longer period of time rather than a shorter period of time. Now, obviously, and then the question is, so if this is the cash that's coming in, so let's say, for example, you would be getting $100 each year times 10, so it would be $1,000 over 10 years, and then afterwards, you could sell whatever is in there. Let's say you could sell it for another $500. So basically, you would be getting $1,500. How much would you be willing to pay for $1,500 with a very high degree of certainty today? And obviously, this is the major holy grail in investing, right? And so basically, what you're trying to calculate is, you're trying to calculate this cash flow that's coming in over 10 years And then afterwards, you're trying to calculate how much can you sell this thing for to someone else, because at the end, this is exactly the cost you would be getting. This is the value that you would be getting, right? At the end, that's what you're trading. You're giving cash away now to get more cash along the way. It's a very simple concept. And so what you could do is, especially with shares, obviously bonds are very, very simple to calculate in that sense because you have very guaranteed cash flow. But so obviously with stocks, you have, with shares, you have way higher degree of uncertainty. And so what I did, and I want to show this to you, I have programmed with a Google Sheet to do this automatically. So let's take a look how this kind of works. And so basically, I do this here for shares. And you can type in the share here. It automatically looks up the share and it fills in a couple of things here. The very first thing it does, it fills in automatically the cash it has. It fills in automatically the debt this thing has. And then it calculates the cash flow. It does this here. We'll take a look actually how this works. And then it looks at the shares outstanding because it has to divide the total amount divided by the shares. So we have it actually per share. So that's a very simple one. Now we calculate the growth of this cash flow, and then we discount it. And the reason we have a margin of safety, the margin of safety is first because at the end, the margin of safety is what basically we are not sure about. And so we're discounting it this way. Then you have a growth rate, which is basically coming from here. So that's the margin of safety. And now you can put in, do you think that the growth or the cash flow is actually decreasing or increasing? So here I expected a decrease in Apple because I just don't think they can keep this insane amount of growth, so it's just going to slow down. And now you need to discount it. And discounting, that's why I discounted cash flow. This is basically your expected return. And that's a very key principle because, I mean, it's pointless to put in 0 here because that just means you're basically paying without expecting any return. So it's basically you're giving $1,500 to return $1,500. Useless. And then you need to type in what's the expected multiple after the 10 years. Now this depends a lot on the business. It depends on how long you expect the business to work. I'm pretty sure Apple exists more than 25 years from today, so 10 years plus 15. And so let's kind of type this in, right? So here it automatically takes the free cash flow with the growth rate. So it calculates from today's, it automatically fills this in, right? It pulls this from the site and it fills this in here. But so now the key is it kind of has a growth rate, right? And this growth rate has a margin of safety. So in this case, it's 8.93. So we're expecting that Apple can grow this by 8.93% per year, but every year it goes down by 5%. So that's why it's kind of decreasing in the growth rate, but it's still increasing. And now, obviously, we need to calculate here the net, right? And that's a very, very key concept in all of it because so we kind of, you can see the formula here, 825 basically, at the end, it's compounded on with the margin, right? So if you go from here to here, this is always where the growth rate at the end fills in all those numbers. So that's at the end what you're always trying to get to in the entire growth. And so now when we add all those together, we actually get to those 630,000. And then at the end, we're expecting another possibility of 15 years. And obviously, if we put in 10 years, that's going to be a bit lower because we have a decrease in everything. So it's not as much anymore because the 10th year obviously has the least amount of cash flow and we're just expecting 10 years. But I think we could do 15 years here. Let's be a bit more aggressive. And so we have 15 years that we could sell it for. Then we have the cash on hand minus whatever total debt we have. And so the total value today, right, is 1.307. Now, the key here is the reason why this is less is because we have 8% here. So if I would go 0, we would actually be paying the exact same amount. Now, this is quite useless because that means I'm giving away money for the same kind of money that I'm getting in return. So I think that's useless. Personally, I think also putting in a number that's lower than 8%, I would probably just buy an index that goes up by 7 to 8%. So let's do 8%. And so now I have the discount here. Yeah, and so that's interesting, obviously. So right now, Apple is, the price is 248, and that updates live, and the intrinsic value is 299. So here, as an accredited or as a sophisticated investor, I can go and I can see, oh, interesting. So Apple, at the moment, the intrinsic value is 299, and I'm actually paying less than that. So I can if these numbers are correct, I can expect the little monkey to shout out at some point 299. That's what I can expect to shout out. And so I can pay 248 because it looks very, 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 very likely to go up to 299. And the 299 is also important. I would be making 8% over time. So that's kind of what I am expecting, right? So that's a very, very key concept. So I'd be actually outperforming that metrics. At 299, I would be expecting an 8% return based on those numbers. Now, we could do this for something else. Let's say we type in, let's do ExxonMobil, just for the, ExxonMobil. Okay, so with ExxonMobil, and obviously here we have a very interesting one. It says intrinsic value is negative. So what we have to do here, we have to go actually on finance.yahoo.com, and we have to manually look it up because here it just doesn't work. So we look up the cash flow here, and we fill in the cash flow ourselves. Great. So let's here type in this one. And obviously here we have now a total different ball game. So ExxonMobil that went down so much, right? And went down crazy much. And at the moment, it's still priced at $37. And so there's so many people who are like, Julian, man, you need to buy this thing because look at the chart. ExxonMobil went down like crazy. Well, honestly, according to the math, with 25% uncertainty, I'm expecting 8%. I'm even putting in 15 years, right? So if I just put in 10 years here, it still goes negative. If I put in, let's say I'm only willing to take 5%, then obviously the intrinsic value goes up. If I just put in 1%, the intrinsic value goes up even more. So at the current price, I can actually expect to make around 1% on ExxonMobil, which is unbelievable. Yeah, so let's try Disney. I haven't tried these numbers before. Okay, so let's try Disney. So here, first we need to, wait, sorry. So let's do it manually again, just to be safe. So let's type in Disney. Let's look at the numbers here. Let's fill this in. So, okay. So at a 25% margin of safety, which I think is safe, I think Disney's growth rate, let's say they can keep it, okay? Let's say we expect an 8% return. We do a 15% multiple at the end of 10 years. Oh man, it's really, really tough. Still too expensive. Wow. Let's look at, well, Berkshire is always a bit of a problem because it doesn't work automatically. So the growth rate doesn't do automatically, so we'll have to do it manually. So here, growth rate, and let's do this one. And let's say the growth rate is Berkshire 5%. 8%. Margin of safety, 25% at the moment, price $180. So based on the current cash flow, now we can try this out, but it's probably not going to work automatically. No, so I have to type it in manually. Yeah, whenever you have a period in there, it's just a bit of a problem. So let's look at financials. And let's see what we're going to come up with here. Yeah, but these numbers look quite solid, so it's fine. Yeah, so obviously a fair value would be, intrinsic value is around at $62, current price $180. Now, obviously, I'm not saying that this is all perfect and correct. It's, well, there's obviously, you have different numbers that you have to try out. Yeah, and then obviously a lot of other factors come in, so you can't only base that on financials, but obviously that's very interesting for financials. Tesla, obviously totally different story here. Let's look at growth rate here. Yeah, I mean, 15, let's do here, I think they can grow massively. Let's do -20. 20. What's happening here? I took the percentage away, so let's just calculate the percentage here. Okay, so they're growing. Obviously, if you put in minus 20, so they can really grow massively. Now, obviously, this has a lot to do with what you believe here. And this is at the end where intrinsic value comes in. You can really kind of get the discount. You can get 8%. You expect 15 years of selling it afterwards. Yeah, but at the end, that's a discounted cash flow. So you calculate the cash flow, you discount it, which is basically your expected return because that's what you're willing to pay. Then you ask yourself, okay, after 10 years, how much do you calculate the value for? And obviously here, you kind of expecting a really, really high value in the future. That's the only way how this works here. So that's why you have to kind of put in an immense growth rate here. Now, obviously, you could put in that, I don't know, Tesla growth, and there's a lot of people who expect here minus 50, right? And that's where a lot of these crazy valuations come in. So maybe minus 20, there's people who say minus 30, right? And that's where these crazy values for Tesla come in. Simply because they grow, they can really kind of grow their revenue, right? At the end, that's what it all comes down to. Yeah. And that's very simple. You can kind of work on a tool like this yourself. So you kind of work out just the numbers and yeah, you fill in the cash flow, and then that kind of gives you some idea and understanding what's the price that this little monkey's gonna shout at some point. Yeah, with this, I hope you're getting value out of this. I use this tool actually when I buy shares. I look at this all the time. If you have any questions, then please let me know in the comments. If you like this stuff and you don't want to miss any further video, give me a thumbs up, and I'll see you at the next video. Thank you all. See you next time. Julian.